Hi everyone, welcome back to my YouTube channel. Back in year 2017, I've created a video about health savings accounts. The video became popular very fast and I still have people watching it every day. However, I've decided to improve the video and make it better, and as many of you suggested, remove the music from the background. So here we go. Here's the updated version of the video explaining the HSA accounts with the updated 2020 contribution limits and rules. Before we go into the details, I wanted to show you how a health savings account works via an example. Let's look at this example. This is Elizabeth. She lives in San Jose, California, and she makes $100,000 per year. Elizabeth is a good citizen and she pays taxes. Her federal tax rate is 24%. As many responsible individuals, Elizabeth has a health insurance plan. She's young and healthy, so she has a high deductible medical insurance plan. This plan has a lower premium, but it works great for Elizabeth since she sees a doctor once or twice per year and wants protection from major medical expenses. She's smart and financially literate, so she decided to have a tax benefit as well by opening an HSA account that will allow her to make a tax-deductible contribution so she can reduce her federal income taxes owed. On top of that, the money in her HSA account typically grows tax-free, at least at the federal level. Funds can be withdrawn without being taxed, and Elizabeth can use them for qualified medical expenses if she has any, or let it grow until she needs it later in life. Here's an example showing a hypothetical HSA tax savings and growth. Assuming that the rate of return will be 2% per year for 10 years and the tax rate would be at 24%, and also assuming that Elizabeth spends on average $2,000 per year in medical expenses. If all the data remains the same, but we lower the amount Elizabeth spends each year for medical expenses to $500 per year, we can see that the growth will be substantially higher. In the description of this video, I will post a link to this calculator so you can estimate what are the tax benefits specific to your situation. You can use this tool to calculate the tax-deferred growth and future value of your health savings account. So, as you can see from the above example, a health savings account could be quite beneficial because it allows you to pay for your current healthcare expenses or save for future medical expenses and have a tax advantages as well. Again, the contributions are tax deductible. If made through a payroll deduction, they are pre-tax. The interest earned is tax-free, and you may make tax-free withdrawals for qualified medical expenses. So let's take a look in detail at HSA accounts. Please make sure to watch this video until the end, as I will provide some disadvantages of HSA accounts as well. So as you already know, an HSA is a special kind of tax-advantaged account that's designed to help you pay for healthcare expenses. Anyone can open an HSA as long as they have a health coverage through a qualified high-deductible health plan. If you don't have this type of health plan, you cannot open an HSA account. Also, if you are not covered by any other health plan and you are not enrolled in Medicare and you cannot be claimed as a dependent on someone else's tax return, then you qualify for an HSA. As previously mentioned, you can withdraw money from your HSA account without paying taxes or a penalty as long as those dollars are used to pay for qualified medical expenses. Qualified medical expenses include things that are associated with your health plan, such as deductibles, coinsurance. You can use the money for vision care, for dental expenses, over-the-counter supplies, and also pay some insurance premiums. The account is owned by you, so no matter where you work, the money that's in the account always belongs to you, even if it was contributed by your employer. You can use the money in the account to pay for your current medical expenses or save it for future medical expenses, including those in retirement. There are many special advantages associated with opening an HSA account. First of all, the money in the HSA account belongs to you. You've probably heard of the flexible spending account. Well, unlike the flexible spending account, there is no use it or lose it rule with an HSA. Any dollars left in your account at the end of the year roll over to the next year. That means you decide whether to spend or save your HSA dollars, which makes it easier to save for the future. Another advantage of the HSA is what we call triple tax savings. Here's how that works. Not only does the money that's deposited into your account reduces your taxable income, but the balance in your account earns interest tax-free, and any withdrawals from the account are tax-free as long as the money is used for a qualified medical expense. That gives you a triple tax savings. And finally, one of the greatest advantages of the HSA is that it's portable. Unlike other medical spending accounts that are owned by your employer, the HSA belongs to you, even if you change jobs or retire. Using your HSA is easy. Just make sure to use the money for qualified expenses. Now, let's talk about contributions. Both you and your employer can contribute money to your HSA account. Remember, employer contributions are not taxable to you as employee, and once the money is deposited into your account, it belongs to you. The best way to contribute to your account is through automatic payroll deductions, and if your employer allows this, use this option, obviously. Not only this is convenient, but payroll deductions help you make consistent contributions and you get the most tax savings this way. Plus, you have the flexibility to change your payroll deduction at any time throughout the year. You have a lot of flexibility when contributing to your HSA, so keep that in mind. You can put money into your account at any time during the year, and you can even contribute up until the tax filing deadline, which gives you more time to fully fund your account. If you fund your account on a post-tax basis, you'll realize the tax savings when you file your taxes for the year. This type of contribution becomes an above-the-line deduction. Let's talk about how much you can contribute to an HSA account. Well, every year the IRS sets a maximum amount that you can contribute to your HSA. This maximum is based on your health plan contract type, single or family. And if you're single, if you have a single coverage, you can contribute a maximum of $3,550 in year 2020. If you have a family coverage, you can contribute a maximum of $7,100 for year 2020. These maximums include contributions made by you and your employer. Together, your contributions cannot exceed these amounts. Every year, the amounts change, of course. There are exceptions to every rule, and with HSA contributions, the exception is that the account holders who are 55 of age or older at any time during the year, they can contribute an additional $1,000 every year to an HSA. This is called a catch-up contribution. Here are just a few more things to keep in mind when using your HSA. Withdrawals from your account are tax-free as long as the money is used for a qualified expense. I will have a list of all qualified medical expenses in the description of this video, so check it out. Also, expenses must be incurred on or after the date that you have your HSA funded. Here's one more thing that is very important to keep in mind. If you take the money out of your HSA account and use to pay for things that are not considered qualified expenses, then you will be paying a 20% penalty plus taxes if you are under the age of 65, or you will pay taxes on these purchases and no penalty if you are over the age of 65. So it's very, very important to study the list of IRS qualified medical expenses to avoid these extra penalties and taxes. As I mentioned in the beginning of this video, I will tell you about the disadvantages of health savings accounts as well. Well, first of all, in order to qualify for a health savings account, you will need to purchase a high deductible insurance plan. These plans have a high deductible and out-of-pocket expenses. Co-pays and co-insurance are much higher than a typical insurance plan. So if you are rarely seeing a doctor and don't use your insurance plan often anyways, this won't be a problem. However, if you use extensively your insurance, a high deductible insurance plan might not be as to your advantage, and therefore you will spend the HSA funds really fast without much benefits. So I would advise, before deciding to invest into an HSA account, analyze your individual needs and situation. Do the math or reach out to us and we can help you run a side-by-side comparison. Another disadvantage of HSA account is that you will pay penalties and taxes if you do not follow the rules. Remember, if you use the money to pay for non-qualified expenses, you will owe taxes and a 20% penalty if you are under the age of 65. If you're over 65, you will pay taxes on the amount spent on non-qualified expenses. And finally, some banks have a monthly maintenance fee or a per transaction fee, which varies by institution. These fees are not much, but it could add up. So do your homework and compare the fees and features of the plans if you are considering an HSA account. As always, we really appreciate you watching and sharing our videos. If you have a question or would like to add something, please comment under this video. If you like our content, please like our videos, share it, and subscribe to our YouTube channel. Thank you for watching, and we'll see you next time.